So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Inflation reached a nearly 4-decade high in November, up 6.8%, up from the same month a year ago. That was the fastest pace since 1982 and the 5th consecutive month in which inflation has actually topped 5%. With the fear of inflation eating away at their purchasing power, this has many investors concerned and looking for anywhere other than cash to park their money. In today's video, I'm covering what inflation is, briefly go over what causes it, why it should matter to you, and then stick around for the end of the video because I'll give you 3 possible hedges for you to consider investing into in order to protect that purchasing power. But before we get into that today, guys, if you do enjoy the video today, if you get any value out of today's video, then be sure to like the video, subscribe to the channel, and hit the notification button just so you get notified every time I put up a new video. So what is inflation? Inflation reflects the broad rises in prices or the fall in the value of money. Generally, this results from too much demand chasing too few goods and services, or if there's a drastic increase in the supply of money. Some economists lump inflation into 2 different types of inflation. There's the cost push inflation and the demand pull inflation. Cost push inflation happens when prices increase because the cost of production is more expensive for the business. This can occur from having to pay employees higher wages or just a general rise in the prices for their raw materials. To offset this, businesses will pass on these increases that they've received onto the customer in the form of higher prices for their goods and their services, which then cycles into the higher cost of living that you would be experiencing. Demand pull inflation, on the flip side, happens when there's like a resilient demand from consumers for a good or for a service.
Generally, the higher prices we're seeing are related to the supply and demand imbalances that can be traced directly back to the pandemic and the reopening of the economy. But it's also the case that price increases have spread much more broadly.
This demand can come from a lot of places. An example that we're seeing today is that because people have been locked down for so long, they all have this extra money that they need to spend. And so what people have been doing is been buying. And instead of traveling, they're actually going through with that, kitchen remodeling or that renovation job that they've been putting off. And on top of that, to make things worse, the government has been putting a lot of stimulus into the economy. So people are sort of flushed with cash and not really knowing what to do with it. So there's a lot of demand now coming up, which puts even more pressure on the supply chain bottleneck that we're experiencing at the moment. Generally, companies can't keep up with this demand, which means there's going to be a shortage for this product, which usually causes a price surge. And again, this has been made worse by all the supply chain issues that's been caused by the pandemic. Even with all that, there's so many reasons that could be causing inflation today, from the labor shortage to the Fed's money policies to the new variants that keep popping up.
The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions.
With interest rates being so low, it all factors in. But the important thing to know is that inflation is here and it's definitely not transitory.
Stop the cap. Stop the cap right now.
So why should inflation matter to you? Well, in a high inflationary environment, there's really no place to hide. Just think about the money that you have in your wallet or the money that you have sitting in your bank account. In a high inflationary environment, it really doesn't take much for you to lose a lot of that purchasing power. In effect, you're not going to be able to buy as much as you would normally be able to or as much as you used to with that money. For example, as shown by this calculator, if in 1913 I purchased an item for $1, then in 2021, which is the current year, that same item would cost you $28. So inflation is a real risk to your purchasing power and to your future retirement plans if you're planning on just leaving your money under the mattress or in a savings account. Another way that inflation can attack you financially is, let's just say, for example, using rough numbers, that inflation right now is going up at 6.8%, which is what it went up in November, right? And when was the last time you got a pay rise that was 6.8% or above 6.8%?
A long time ago.
So what I'm trying to get at is that inflation will increase the cost of living, but the pay rises that you're receiving are not keeping pace with that. So essentially, it's almost like taking a pay cut. If prices are rising faster than wages, which tends to happen in a high inflationary environment, basically that means people will have less money to spend and less real purchasing power. So inflation erodes your spending power. So if it's going up more than the average salary increase that people get, people will start to notice when you go to the grocery store, when you're going to buy, more recently, a used car, it might feel like you're getting a lot more money nominally, but you're actually able to buy a lot less with that money. So you might start noticing that again when you go to the grocery stores, or if you're in the market to buy a used car. You really start to see there the dangers of inflation. So what can you do to hedge against inflation? You definitely can't leave your money in the bank, and you definitely can't leave it under your mattress. You can, however, invest in Treasury inflation protected securities, or TIPS for short.
Perhaps play a little game called Just a Tip. For a second, just to see how it feels.
TIPS pay investors a fixed interest rate twice per year, but the principal amount is adjusted for inflation as measured by the Consumer Price Index. If you are someone that's concerned about inflation speeding up in the future, then TIPS might be worth you looking into, because they are indexed to inflation, which means if inflation goes up, the interest rate that they're supposed to pay out will also go up. But also keep in mind, if things do turn around, like say the Fed decides to raise interest rates and inflation to tame inflation, and inflation goes down, the adjusted interest that's paid out for you will also go down. So that's something to keep in mind if you're thinking of investing in TIPS. They're also backed by the US government, so these are considered, some of the safest investments out there. So that's also another plus if you're thinking of investing in these bonds. Now, the next thing that you can invest in is real estate. If you're able to take advantage of these historically low interest rates and secure one of those long-term fixed mortgages, then that would be a really good way to sort of hedge against inflation. On top of that, you will be paying back that future debt with cheaper money thanks to inflation, so you're kind of taking advantage of the higher inflation rate. Plus, you always have the potential upside of the house appreciating in value. Now, I understand realistically that we can't all just go out and buy a house tomorrow. So another way that you can get exposure to the real estate market is just through Reits, or real estate investment trusts. Now, I have made a video explaining Reits very briefly. I'll link that up top. But essentially, a REIT is a company that takes the money that it collects from the pool of investors, which would be you and I if you were going to buy the stocks in these companies. They take that money and they will go and either buy properties, develop properties, and sell properties. Generally, they will invest it into income generating properties, and the income that they make from these properties will actually then be distributed out to you, the investor, in the form of dividends. So you will not only get the upside of having a high dividend yield asset in your portfolio, but you also have the potential upside of the share prices appreciating in value, which will again help you keep pace with inflation. And the last investment vehicle that I have for you is, of course, my personal favorite, stocks.
Stock market guy.
The stock market has produced a return of around 8 to 10% over the last 100 years, which not only keeps pace with inflation, but also will help you generate a pretty healthy nest egg. So stocks are a great long-term vehicle for hedging against inflation and also building wealth. As Warren Buffett says, you want companies with high return on invested capital while requiring a low capital expenditure. Having a low capex is going to help them maintain their earnings. Meaning, as inflation rises, these companies are able to pass on these increases to their customers without worrying about them having to go to their competitors or losing business to their competitors.
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth, and that have strong positions that allow them to increase prices with inflation.
That's because these companies have what most value investors call a moat, an intrinsic competitive advantage that protects the business from its competitors. A classic example is Coca-Cola, a famous Buffett investment. Between the years of 1886 and 1959, a can of Coke was around 5 cents. Compare that with the price that we're paying today for a Coke, then you can see how a wonderful business with a moat can pass on price increases to their customers without worrying about their customers going to the competition. Even today, when you feel like a cola, you don't say you want to go grab a cola, you say you feel like drinking a Coke. And that's the power with a business with a strong moat. You really want to focus on buying wonderful businesses at reasonable prices and then just allowing them to compound your money for you. If picking individual stocks is not for you, then just be an index investor. Buy the S&P 500 or any broad market index and then just average into that year after year and let the market compound the money for you. Having a long-term diversified portfolio has also proven to be a really good hedge against inflation. And also, not just a hedge against inflation, it's also proven to be a great way to build a really, really comfortable retirement nest egg. So guys, that's the video for today. Comment down below on what you're investing your money in today. What hedges are you using to fight against inflation? Be sure to like the video and subscribe to the channel. It's really much appreciated. It helps support the channel a bunch. If you enjoyed this video, click on the videos on the screen now. It'll take you to more educational videos helping you with investing and just helping you understand money a little bit better. But until then, I'll see you guys in the next one.